Here's some news for the week. We got single family versus multifamily, what to expect in 2026. Also, deal flow and apartment sales. We're going to be talking about what's actually happened in the multifamily space and then what to expect coming into 26. And then what some of these new lending caps are coming into 26 for Fannie and Freddie, which are the main agencies for lending in multifamily space. So, some really good news in the multifamily space. And we're going to be comparing that to the single family as well. John, it's great to be here with you today.
So good to be here, Mark. Canada and US have different Thanksgivings, right? But we just had ours down here in the US, and it's nice to have some opportunity to spend some quality time with the family and recharge the battery, so to speak. So, as you know, we're deep in our 2026 planning. And so excited to talk about some things that are happening that are signaling 2026 may be a fantastic year for multifamily. So
Yeah.
look forward to diving in today.
I'm still enjoying the double Thanksgiving. So Thanksgiving and enjoying that with the in the Canadian Thanksgiving, which is in October, and then you got the second Thanksgiving, which is the US Thanksgiving there in November. It's so close to Christmas, and then you got the third one, you got Christmas. So it's like the
Yeah.
back end of the year, John, I got to make sure I keep hitting the gym because
Oh my
it's easy to
gosh.
get off track, right?
100%. Yeah. Definitely a lot more dessert and, probably a few more, alcoholic beverages than usual. And so, yeah, it's definitely that time, but for me, I actually like that kind of, it's like Thanksgiving is the signal to the start of that holiday season. Right. And so, generally I'm sure you're similar, have, some dinners with friends and, get together, some holiday parties. So it's one of my favorite times of year, especially I have kids. Right. So that to me is just the most exciting thing, especially when we get close to the Christmas holiday, just seeing how excited they are. And, it's just a pleasure. And we're very fortunate that we can provide, very, very wonderful Christmases for our families. Right. So it's a good time.
Yeah, 100%. So let's dive in here, John. So let's talk a little bit on the single family space. So this is actually very similar between what's happening south of the border and then in Canada as well when it comes to single family listings. So single family listings, so these are homes that are available that are on the market. That's at a high right now. So listings are accumulating and the number of sales have gone down dramatically. And so when it comes down to the actual single family space, that seems to be bottoming right now. And from overall sales standpoint, we're not seeing these massive drops in pricing there. So the pricing is still high. We've seen interest rates come down. What are we looking at? 6.96 in the US to 6.58. That's so there's been some drop when it comes down to overall interest rates, but affordability is still the major thing, which is pushing people over to the rental space, and more people are renting with our growing population, which is really helping multifamily. So maybe John, like what are your insights? We've gone through a few different articles,
Yeah.
and I'm curious to get your insights on that from single family. Moving over to multifamily space, and then what we're able to attain from
Yeah.
these three articles that we read. Marcus Millichap is one, and we got there was two other ones, John, that we went over as well.
Yeah, Globe Street doing some reporting on the Fannie Freddie, and yeah, 100%. But my lens is kind of obviously more from the U.S. side of the border where I reside, and as you know, and a lot of our listeners, if you've been listening, you know that both Mark and I got our start in residential real estate. So it's interesting, right? The assumption was always, well, if interest rates go down, home sales will go up. But the opposite has occurred, and it's driven by so many factors, right? So if you look at the Great Recession, is really where a lot of this started, where new homes just stopped. I mean, there was like a 3-4 year period where basically no new homes were being built. And so coming out of the Great Recession, you started to see building occur again, but there was already this sort of like demand gap. In other words, there was like more demand than there was supply. And so we started seeing home values go up pretty dramatically. Some of that was post recovery, right? Like we were gaining back the losses because during the Great Recession in the United States, on average across the United States, home values dropped about 30%. But that quickly got made up. And then the interesting thing happened is counterintuitively, when the pandemic hit, because interest rates were so low, we saw an explosion in home transactions, And so some things occurred that were quite shocking to me, honestly, when I first really dug in and started looking at this data. For example, the National Association of Realtors does an annual report. And even though I'm not involved in day to day residential real estate, I still read it every year. I still have equity in my prior business, so that's part of the factor there. But in the multifamily space, it's imperative we know what's happening in the single family space, right? Because that'll impact our demand. And so a few things happened that were quite eye opening. So, for example, in the United States, on average, the average home buyer was 28 years old pretty much forever. And now in 2024, it went to 38. In 2025, it is now over 40 years old. So, first time home buyer, the average age is 40 years old. I bought my first home at 22, 23. Now I was in real estate and I was making some good income, and I saw the value in buying a home as my first sort of investment in real estate. Um, but I look at my 21-year-old and, he's pursuing a law degree and I have no doubt he'll be very successful. But like he even tells me today, he's like, I never think I'll own a home. Like that, there's a pessimism in the youth about their ability to even ever buy a home. And so in Atlanta, for example, home values on average 5 years ago was 280,000. Today it's 450,000. So, that mortgage might be $3,500 a month, right? If you can put 20% down. So affordability is becoming a big factor. And we haven't even talked about the rising cost of, energy and groceries and, just the general impact of inflation. So, what's really happening is I think the United States is sort of shifting more into a nation of renters versus owners, right? Um, and so, on one hand, that is scary to me. I think home ownership is a clearest path to wealth creation that one can have. And obviously, for a lot of individuals, especially those in, say, the working class and middle class, their home is their largest investment. And so, on one hand, I'm scared for those people. But I will say, as somebody who operates multifamily buildings, we know that that demand will continue to shift over to apartment buildings that offer, good, clean, safe, quality accommodations, but at a much more affordable cost than owning.
100%. And this is something that's happening right across North America. In Canada right now, you have pricing. Yeah, pricing similar has dropped 25 to 30% on the single family space. But what's very different between Canada and the US right now is in the multifamily. So in Canada, they have this program called the CMHC, which is similar to Freddie Mac and Fannie Mae. It's kind of quasi governmental agency. And they have this program called MLI Select, which is basically it allows you to have these high amortization loans. And if it's more environmentally friendly, you get certain credits and et cetera, which allows you to even get more, we'll say superior lending, lower interest rates, longer amortizations. And so what's happened in the on the Canadian front is that a lot of the developments that were actually initially going to be condos,
Mhm.
they've actually transitioned those to multifamily. And so with that, because the condo space is just oversaturated right now. I think there's like 3, maybe even 4 years before they get back to the point of equilibrium where you have supply and demand that match up. They just overbuilt in a big way. You had a huge investor influx that had come into the Canadian market, especially in the GTA, which is Toronto area,
Right.
and so they overbuilt, and so pricing in condos they demolished, and so the investor base actually has disappeared as well, evaporated. So it's just end users that are buying. So pricing's come down. So the condo market, developers aren't building there, and so they've transitioned their developments to multifamily, and so the multifamily space has just boomed, and there's so much supply coming online that I think they're overbuilding right now. And so
Yeah.
what's going to happen is there's rents that are going to be coming down. Rents will be coming. They're already starting to come down right now because of this oversupply that's coming. But down in the U.S., they don't have these government incentives, and so multifamily has not been being built over the last like 2 to 3 years since the peak of the market. And so the where multifamily got into a little bit of a craze at the peak, there was a lot of new development that was coming. Now that's getting absorbed in the open market right now. And there because there hasn't been new developments started or permits started, we track that through our online subscriptions that we have. CoStar is namely primarily one of them. We're tracking that number of deliveries are actually falling off a cliff,
Right.
and we saw it in 25, but definitely in many cities by 26, at least in the back half, we're seeing that fall off the cliff, which what's going to happen there is we're going to see very strong pressure on increasing in rents because you have growing population, but you don't have that new demand that's keeping up with or the new supply that's keeping up with the demand that's being driven there. So it's interesting because multifamily in Canada, we're going to see that we'll say downward pressure in pricing, and
Right.
there's upward pressure in these high growth emerging markets like Atlanta and Tampa, Charleston, South Carolina. And it's interesting because at the peak of the market, both markets were going up,
Yeah.
but in the multifamily space, based on what I just went over with supply and demand, and with development happening up north of the border, and then in the south that it hasn't been, we're going to see if you're going to put a dollar in one side or another when it comes to multifamily space, the case is so strong in these high growth markets, and in the single family space, John, I think it's a very similar story, north of the border and south. There hasn't been a lot of new development that started there in the single family space. And so, as interest rates are starting to come down, I think that there's going to be slow growth. But I think the multifamily space, if you're going to put a dollar in any area right now, that's definitely the case for it is extremely strong.
Yeah, that's right. I mean, so in the US, kind of put a bow on it, even with home sales being down 30 to 40%, values are actually still going up because if you look at actually the new single family home starts, it did tick up a little bit in 2024. There was just over a million new homes being built in the United States, but the year prior was about 950,000. And the National Association of Realtors, once again, they do these big annual reports. And just to keep up with sort of the current demand, people looking for single family homes, we're about 4 to 5 million short of where we need to be. And so, one of the things that's often not talked about is, we obviously think about land costs, materials cost, and what does it take to construct, labor costs, right? There's really a fourth thing that's often not talked about, which is regulatory costs. And for example, I live in a very nice suburban market of Atlanta. I like the way that they manage the city, but the reality is, it's like very difficult to get a condo building approved or a multifamily building approved. But further, they'll say, look, if you're going to build something new, it's got to be four sided brick, and it's got to have X, Y, Z. And so that drives up the cost, right? Because instead of maybe doing front brick and hardy plank on the side and save a few bucks, they're saying, no, 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 it's got to be four sided brick. And that's just the example of where I live. But those regulatory costs are becoming a huge issue as well, as local markets, have to factor things like traffic. Like if you build a multifamily building and dump a couple hundred more people on the road, can the road support that? And so I guess I would say I don't really see a huge opportunity for a solution anytime soon. So our bet is bet on multifamily, just simply put.
Yeah, 100%, John. I totally agree. And multifamily in these emerging markets, south of the border right now is to me is the case for it. I
That's
really
right.
believe that.
Those
Um,
pathways to progress we always talk about, where the growth, the population, the
exactly.
culture. That's right.
Yeah. No. Exactly. So these three reports that we went over, Marcus Millichap, Globe Street, and then we got MSCI Real Assets Report. One of the main takeaways, John, after reading through these articles that we went over, is that the sales overall cap when it comes down to mortgage lending
Yeah.
is they're increasing how much they're going to loan out when it for Fannie and Freddie for this year. Okay, so Fannie and Freddie, so 88 billion each is what the new caps are in 2026.
Yep.
So for 2025, it was 73 billion, and 24 was 70 billion. So they're looking to increase the amount of lending they're going to be doing coming into 2026. And so this is really good case because this means access to capital is going to get a little bit easier in the multifamily space. And if there's more easy, we'll say, lending, then there's going to be more demand for those types of assets. And with more demand, this is going to increase the overall values of the multifamily space. Is it definitely, it's a really good sign.
That's right. Yeah. So what happens is Fannie Mae and Freddie Mac are what we call pseudo government agencies, and that actually really started kind of in the Great Recession because as most of us listening, I think we have very savvy, educated listeners. Understand that the housing market caused the crash, right? The lending just got too loose. In fact, Mark, I was selling real estate in '02 and '03, and they had no doc loans. In other words, you would just sort of show a bank statement with 2 months of income, and as long as that bank statement supported the mortgage payment, you could get approved. If your credit score was okay, right? To the point where we used to joke like, if you have a pulse, you can get a mortgage. And
Yeah, that
um,
and that was actually in The Big Short. I don't know, like,
yeah,
I think we talked about
yeah,
this, is
yeah.
where he went to there was like a waitress and she owns like 5 houses, and it's like, yeah, they're just giving them out like
And so, look, what ended up happening is the government sort of stepped in and had to bail Fannie and Freddie out. And so they took more control. And so we have another agency called the Federal Housing Financing Agency. And so this is a group of economists that are looking at what's happening and they're predicting what should happen going forward. And so they've allocated more money to Fannie and Freddie. So to us, this is a clear signal that they are bullish on this market. And it was interesting because what happened this year is they hit their cap in like September. And so what happens at that moment, it's not to say they no longer lend, they just make the terms a little more unappealing. I'll just say it that way. So, for example, you might have to pay a higher interest rate, or perhaps they make prepayment penalties a little more robust to almost discourage, going in. And so it was interesting. We actually had a deal. We've submitted a letter of intent on recently, and Freddie Mac wouldn't even quote it because they're like, we're full. We don't, it's not they don't like the property on January 1st. They'd probably take it, but they're just saying we're not taking it in December, sort of approach. So they didn't even quote for us. So raising these caps is a clear signal that the economists are looking at the data and seeing that multifamily is performing well, and they should be allocating more funds to those investments going forward. So this is really exciting, and I think we'll also see hopefully some downward pressure on the treasuries, right? Because so often, the headline is about the Fed lowering interest rates, whether they did or they didn't, but the bond market really controls the interest rate based on the supply of treasuries, right? And so we've seen treasuries actually go up after a Fed rate cut. So that's what we really watch, is the movement of the treasuries. And so I think with this combined, raising of these caps, and it's interesting, Mark. Depending on who you ask, are we in an AI bubble or not? Right? 8 stocks have largely generated the majority of the returns in the S&P 500. So I do expect to see some challenges next year in the stock market and the public markets. Right? No doubt about it. In fact, I was at a dinner last night with my financial planner. She does an annual holiday event, and we were sitting near each other at the dinner table, and we were sort of, not trying to talk too much business. It was really more about, fellowship and meeting some new people and things like that. But, when I look at my portfolio, I'm de-risking myself of AI. I'll just put it that way. Sold off my Nvidia and a few others. It feels like there's a lot happening there. So this is a year that if I were an investor, and I obviously invest in our own deals, but I'm allocating more of my funds towards private investments, specifically in multifamily, because we've touched on this so many times, Mark, but it's a core human need. There will never not be a demand for housing, right? And so if you're going to bet on a hard asset class, to me, you need to bet on that. I would not be betting on retail or office or some of these others, or car washes, right? If there's a recession, right? Do you think people are going to keep their $39.99 a month car wash subscription, or are they going to cancel that and maybe wash their car once a month, right? These things will happen. So, asset class we're interested in is multifamily because that demand will never go away.
Well, 100%, and it's at a low right now. Like,
Yeah.
pricing's come down 20-30%. And here's an interesting to add on with the markets right now, especially the equities markets. So Warren Buffett and Berkshire Hathaway, they're at an all-time high for cash reserves. And so he's ready to pounce. It's interesting. One of the largest REITs in Canada, they've actually paused their redemption option. So, which means that some of the larger investors, you can't redeem as initially was told to them. And one of the main reasons for that was uh, they had a some of their larger investors were looking to pull their funds to become more liquid to
Right.
be ready for a stock market drop type thing. And so that's where it's interesting right now because from a dollar in standpoint, if you have dollars in equities right now, it's like if it's at an all-time high, it feels good. It's like it's sexy. Everybody's making money on it, but then you got to really look at, okay, if you redeploy, you took some money out of that and you put it into a another asset class that has been depressed but has very good fundamentals, like say multifamily, for example. This is a phenomenal time to do that.
Yeah.
It really is, and we're actually seeing it not just in real estate. So cap rates overall over the last 12 months have actually decreased by what is it 0.1%, which is still so the 0.1% is still an increase in overall value. So when then cap rates decrease, so they 10 basis points, so it's like 0.1%. So it's basically it when cap rates decrease, values go up. And
That's
so
right.
we've seen that happen. And so we really believe in all the data we're seeing is that multifamily is bottoming out and is starting to actually come back a little bit right now. And so that's where over this next 26, 27, and definitely coming in 28, we're the data is telling us that we're going to see some really strong increases.
Yeah.
And so from a dollar in standpoint, with the equities market at an all-time high, and getting into some of these multifamily deals, I'm screaming from the rooftop, John, as much as I can to as many people as possible, is like multifamily investing in emerging markets right now, like Charleston, Tampa, Atlanta, these high growth markets, buying in right now. I really believe in like 3 to 4 years, we'll be looking back in today and say, wow, I'm really glad I bought in at that time. And, I just go back to if it doesn't feel like it's the right time, which in real estate right now, it doesn't feel like it's the right time. It's not sexy to buy. But
Right.
in my, almost 20 years, 2 decades in real estate, investing and selling billions of dollars worth of it, I recall that the best times to buy didn't feel like a sexy or like it was the right thing to do based on what everybody else is doing. But the guys that made the most amount of money through the years, through the centuries, they went the opposite way of what the herd was doing. And
Yeah.
that's really the high recommendation right now is like multifamily is the time to jump into that space out of all asset classes that we're seeing data points on.
Yeah, that's right. So that report from MSCI, the Real Capital Analytics report, covered some kind of metrics happening, and you just touched on one, right? We're seeing some cap rate compression. We've actually seen values tick up 0.5%, and these are nationwide averages, right? So, we look at nationwide averages, of course, but when we're analyzing a deal, we're looking at the market and the submarket. So, like very like drilled down into what's happening in that actual neighborhood, in that actual area. Um, but what I'm thinking about, Mark, and we actually had a conversation yesterday on this. You just read Sam Zell's book there, and Sam Zell was an investor that accumulated a large portfolio that real estate assets that he sold to Blackstone. And the book was talking about his whole premise was replacement cost, right? Like that discount to replacement cost being that metric. And it was interesting because at Mark Spain Real Estate, we actually worked with Invitation Homes, which was owned by Blackstone in 10, 11, and 12. And what was interesting is they were buying like thousands of homes a month in metro Atlanta and all across the United States. And they were kind of like a laughing stock of the agent community. And I mean, because we would hear it, we were one of their vendors. And so we would make offers, and people like, oh, these guys are morons. I can't believe they'd pay this price. And time basically revealed they were 100% correct because look, everybody was scared and they saw, look, we can buy a single family home at 60% of the replacement cost. When home building starts again, that's going to just naturally drag the value up of these existing assets. Now, it'll never be worth the same as a brand new, but if you're buying at a 60% replacement cost and then somebody to build a new home has to pay that 40% more, certainly that's going to lift the value. And so that's our thesis, right? Like when we're looking at deals, that's one of the first things we talk about is like, what's the replacement cost, And we went through our deals. In some cases, we're buying deals. I mean, our Georgetown deal, what'd you say, $90 a square foot?
$90 a square foot
Yeah.
after we got that price change there. And 169 for like Noonan. So 29 minutes from the world's busiest airport,
Yeah.
45,000 population. Great asset, like seven
Beautiful.
units per, was it 7 units per acre?
Correct.
So you're buying like a lot of land. Like even that was $169 a square foot. To replace that, you're at like 300 to $350 a square foot. We're buying these at like half and sometimes even a third. A third, like in Charleston, we're buying like we got an offer on a property that's built in 2004, and that's like $130 a square foot
Yeah.
is what we have the offer, and we're getting close to, we're pretty close to where we need to be in order to grab it. And so that's where, like, it's hard, and especially so same Zell, this guy is a legend in real estate. And so he just kept on talking about this idea of replacement costs, and he took actually that same thesis into multiple different businesses, like train rail carts, and
Yeah.
he looked at, supply and demand and what the replacement cost would be. And so that fundamental idea, it's so simple, yet
Yeah.
there's so much wisdom, and it's proven out time after time after time. And that's where right now, John, is like, that is our overall thesis. We buy well below replacement, like you were saying. 60% is what invitation, what Blackstone were buying
Yeah.
these properties at, and we're buying these at like 50% and even less than that for replacement costs. So what that tells us is we know what future competition is going to be paying. We know what future competition cost is going to be to get into the market, which allows us to actually charge less rents
Mm.
by significant amount and still be profitable. And this plays into the whole idea that more and more people are looking for affordable housing. They're
Yeah.
not looking for the, $3,000 a month rental units. They're looking for, like, say 1,500 to 2,000 a month,
That's
and
right.
we can charge that. New assets can't charge that. So, like, we've looked at all the data points, and we've been very strategic on the types of assets that we're buying. And this is where right now, like, all the stars are all aligning. Now, listen, there's always things that can come up, like black swans, like who would have expected COVID. But
Right.
when you're investing and you stack enough of these odds in your favor, eventually the house is going to win.
Yeah. Absolutely, man. Yeah, to me, it's a clear signal we're at the bottom when we're seeing a slight increase in values. We're seeing cap rates starting to compress. We're seeing lending limits start to rise. The signals are all there. So this is the time. If there's never been a better time, it's
Yeah.
right now.
Hu
Yeah.
100%. So, if you guys, that are listening out there, if you'd like to learn a little bit more about what we're doing, you can go to fulloutinvesting.com. We actually have a video there, and we actually have a sample deal there as well. You can take a look of what our multifamily deals look like, some of the return metrics as well. You can actually book a one-on-one call. There's a link there that you can book that one-on-one call just to get a better understanding what your goals are, and to see if there's alignment in our next acquisition where you can actually come on and partner with us. Go to fulloutinvesting.com. Thanks for listening, guys. And if you do have any questions, you feel free to reach out. Thanks for listening in to the podcast. We love you guys. Keep dreaming and investing big.